What's up, guys? It's September 6th, and let's go over this crazy thing that is the stock market. This roller coaster ride that just takes your money and gives you none of it back to you. It doesn't let you grow your wealth. It just takes from you. So let's go over what's going on because it's important, right? We're getting slammed in these last couple of weeks. So the rally that we saw starting in June has completely fizzled out and left us in tears. So I want to break that down for you guys. But before we do, please hit that like button, hit subscribe. Hopefully you learned something from these videos and you have some fun in the meantime. Okay, let's get to it. All right, so here you have the markets for September 6th. That's today, of course. We have the Dow Jones down about 0.5%, a little bit over 0.5%. S&P 0.5% as well, a little bit under 0.5%, and the Nasdaq 0.75%, and then almost a full percent for the Russell. That's your small cap value names. We got the VIX raised over 25, which is a sort of like a fear area. Definitely anything over 23 would be a fear area. Anything over 28 would be that kind of panic VIX that we're looking for to be adding stocks big time. Okay, now we have the bond rates 3.35. Last time we spoke about a couple weeks ago in my last video, they were 3.3. So you see that spike higher, and that's bad for stocks. When the bond market ticks higher, it kind of reprices stocks because all these hedge funds and then big time investors now leave the riskiness of stocks and move to more secure bonds because they're yielding more. So we don't want yields to go higher. We want them to go lower. That works against stocks. But what works for stocks is the price of oil under 90. So it's a little bit of a balancing act there for stocks. Last time we talked, 93.40 was a barrel of WTI crude, and then Brent 99, now sitting at 91, and natural gas was 928, now sitting at a little bit under 8, which is good. That's I'm kind of surprised to see that with what's going on in Europe, that the price of natural gas has been dropping. That's good, I guess. Okay, now we're going to focus a lot on the Federal Reserve because there's a lot that happened. We had Jackson Hole last week, or was it a couple weeks ago? So, yeah, I mean, last week or 2 weeks ago that Jackson Hole happened. The Federal Reserve Chair, Jerome Powell, came out and just pretty much started quoting Volcker, started saying that the market, he didn't like the markets rallying in the face of their fight against inflation. Essentially, they were just ticked off about that, and then the market sold out after that. I think the market just went up a little bit after that and then completely sold off until today. I don't think we've had maybe a green, I think maybe we had a green day or two after that in a couple weeks, but we're like in the 7th day of a bear market sell-off here. So we're still in a bear market. The bear market rally has fizzled out, and again, we're left in tears and hoping for better days ahead. Okay, we're going to talk about inflation a little bit and also some market volatility charts and kind of like my thinking is between or before we start buying big time in this market. Okay, let's move on. Now, let's talk about the Federal Reserve, and it's something that I kind of hesitate to talk about because the Federal Reserve is something that when I started doing stocks, I didn't know that I was going to have to follow so closely. If 2022 and 2021 taught me anything, is that the Federal Reserve is one of the most important things to consider when you're buying stocks. It's not the only consideration, of course. You're still looking at business fundamentals, valuation, technical analysis, but I kind of added a step after the technical analysis, which is the Federal Reserve and what the appetite is for risk in the market. Okay, so when we talk about the Fed, right, the Fed, think about the Fed as a man with a sledgehammer, just how it is right here. The Fed is not a surgeon. The Fed is a man with a sledgehammer. It has no other tool but a sledgehammer in order to beat down inflation to a pulp. And it can't just sit there and say, hey, I'm the Federal Reserve. I want to, reduce inflation in apparel and food and rent and just target those things specifically. The Fed is not designed to do that. The Fed has to take a sledgehammer to all of it because the only tools they have are rates, raising rates, which the current rate is 2.5%, and quantitative tightening. Okay, quantitative tightening is the opposite of quantitative easing. You probably heard that word before, QE, quantitative easing, which means is the printing of cash. If you guys remember in 2021, the memes of Jerome Powell printing cash and just printing more money, that's quantitative easing. The opposite of that, quantitative tightening, is taking that cash back and selling their bonds. So this is something that a lot of people focus on in the stock market is what are the rates, where are they going to go? They don't focus on the quantitative tightening, which is stepping up in a big way in September. So when you're talking about rate increases of 0.75%, 0.75%, plus quantitative tightening, that is a humongous hawkish move. That is an extremely aggressive move for the Federal Reserve. So we've already had plenty of 75 point base or 75 bips, what they call, right? Basis points, bips, rate increases, and then we've had plenty of 50s. Now it's time for that to go from 25 to 50 to 75 back to maybe another 75 or a 50 to the 25s, and then sort of kind of hike back down, still hiking rates, but at a slower pace. The market rallied after June because they'd expected this slowing of pace, because the market said essentially, hey, inflation peaked. The Federal Reserve shouldn't be as aggressive. But through Jackson Hole, the Federal Reserve told us, no, we're going to stay aggressive, more hawkish for longer. That was essentially the theme of their meeting in Jackson Hole in Wyoming, and we got clobbered after that, okay? So in considering inflation, we talked about this a bunch of times, but we have the softness of inflation. These is essentially the fights that the Federal Reserve has already won to this day. Knock on wood, they've already won these fights. And then these are the fights that are sort of working on right here. We have energy, which has fallen significantly from its all-time highs in the 120s and now sitting at about 85, just like we talked about. Was it 85? Yeah, I think it was 85. And then that's energy, but also with energy, we have the price of natural gas. We have Europe in a big bad situation with Russia cutting indefinitely their supply of natural gas. That's not going to help that energy inflation number, okay? This is a worldwide thing, not just a United States thing. And then we have housing, which is softening. If you look at house listings, these prices just keep going lower and lower and lower and lower. The problem is if you break the housing market, which is the engine of the economy, what happens to the economy? Do we go into a recession? How bad of a recession do we go in? And how does the market price that in? Okay, we have food that is softening as well, just like energy. I put these two sort of in the same category because they go hand in hand. And then cars softening and travel as well. The summer travel season, the revenge travel season that we talked about before, effectively over. And then what's stubborn, what the Federal Reserve has yet to win at, is wage inflation. And you would think, is wage inflation not a good thing? And I would say, of course, if you're getting paid more, it's definitely a good thing. However, if things cost more, you're not getting a pay raise. That's the difference. So this has to come down for the Federal Reserve to say, okay, we've done enough, right? And of course, rent is another thing that I find very stubborn in the overall economy. I have no idea how that's gonna resolve, guys. I really don't know. I've looked into it. You have to build more rental properties in order for rent to come down. People need more choice or more homes in the market that they can rent, but that also takes from the supply of supply of homes that people can buy. So it's a big complicated equation, okay? But I just want to put it here so you guys give you some context as to how all these things play out, okay? So when it comes to the Federal Reserve and how hawkish and how hard they're going to hit us with this hammer, we live in this Bizarro world, right? You guys remember Bizarro, the anti-Superman guy, that he's essentially the opposite of Superman? We're in that Bizarro world where the good news is bad and the bad news is good. So I'm talking about jobs reports, right? When we have strong jobs reports, the Federal Reserve does not like that. We need jobs reports that are weak in order for the Federal Reserve to get off our backs as investors. It may be the best thing for investors, maybe not the best thing for the country. But at the same time, things go hand in hand, right? Now we have manufacturing. We had some really strong manufacturing numbers today. Not good for the Federal Reserve. Federal Reserve is going to want to quash that so it doesn't feed into inflation. And then CPI reads and PPI reads, CPI Consumer Price Index, PPI Producer Price Index. Those readings come next week on Wednesday. We're going to be watching those because we need inflation to cool down. These are probably the number one factors that the Federal Reserve looks at when determining what to do with interest rate hikes. Very, very important here, CPI and PPI. And then we're watching for Fed speeches, right? Us and the entire market is watching for Federal Reserve speeches and the tone of these speeches. Is the speech a hawkish tone or is it a dovish tone? We really have to make sure that we watch those. So essentially, this is the bread and butter of the stock market at this point. The Fed is not your friend. Period. End of story. We need the Federal Reserve to become our friend one more time so stocks can rally and we can get back to a normal mode of the stock market and not this kind of bleeding every day and volatile ups and downs that kind of eat up everybody. Traders, day traders, swing traders, long-term investors, everybody's getting eaten up of this market. The only people that are not getting eaten up are the people that are doing these kind of like bearish short-term bets. I think those are probably the winners of the market, these kind of, really short-term traders. But at the same time, there's a lot of things to consider in these short-term trades. So I wouldn't even call them a winner. I would call them more in control of the market than anybody else. Now, I want to give you guys an example moving on here on, sort of like bear market rallies, bear market technicals. We see here a 2018 bear market that kind of surfaced when the Federal Reserve did their taper tantrum. Same exact situation, not so much for inflation at the current levels that it's at, but as a rate hike cycle. And you can see here in 2018, the S&P came from this level here, and that was the level when the Federal Reserve started to knock down the economy with the sledgehammers of rate hikes. And you can see that the market went down, had a bear market rally, retest, bear market rally, and then it broke down in that support level, right? So when you see these sell-offs, this is a very common pattern that you see in the stock market, not only in the indices, but individual stocks as well. This pattern is very common in which it's a retest pattern essentially. And this is a point here in which your stock can go right up or right back down how it goes here. There's kind of like no in between there most of the time, okay? But so when we see these technicals, in the case of 2018, the Federal Reserve kept their hawkish stance despite the best attempts from President Trump at the time, who was insulting the Federal Chair, the Federal Reserve Chair at this point. He was saying, hey, I'm trying to control inflation, I'm trying to control the economy, and he kept driving it down. But of course, you see this sort of like a cup and handle formation here, what's called a cup and handle. It's kind of like this U shape that just goes higher, and we get to new highs on 2019, and that's when the trade war starts, and we have another bit of a sell-off there after the trade war with China. Another example to show you guys is the dot-com bubble. And what it is, if you guys remember, maybe you don't remember, I was investing in the market back then, but it's a big point in the stock market's history, the dot-com bubble, in which all these, pets.com, nike.com, all these websites pretty much got to their glory point, and then all these stocks sold off and declared bankruptcy, and all these tech valuations just totally tanked because they were just extremely overvalued. So you see here tons of patterns like this, right? Same thing, retest, and sell off, retest, again here, retest, sell off. And that's the pattern essentially that we're looking at. That same pattern right here, retest, sell off, right? They don't look exactly the same, but that's the point. You got these bounces here, you got a retest, and right back up for the rest of 2, 3, 4 years until the great financial crisis. So what I want to make sure is that you guys understand is that we could be seeing the same pattern here from the S&P 500 and essentially all the indices, more closely resembling the 2000 dot-com bubble. And to bring all this to context, I want to show you guys the chart of the S&P 500. We see here that the S&P 500 hit its June lows, 36.39, right here on June 16, and then it went right back up in this rally that has just fizzled out recently in the last couple of weeks here, and it's currently sitting at 38.99, okay, or 38.98 right here with the S&P 500 futures that are usually a moving target because it's after hours. So what we're looking at here and what I'm looking at is the closer we get to this level, the more a buyer I am of stocks, but I'm a nibbler before I'm a big time buyer, because we have to watch out for that sort of M pattern to realize and either to break below this level or to get back above it, depending on what's going on with the economy and the Federal Reserve. So when I'm looking at the stock market, I can buy stocks like today buying Marvell. What else did I buy today? Rocket. I bought some Palantir the other day. But those are very, very small buys. Those are really miniature buys because of the technicals of the stock itself. But when it comes to the market, I'm waiting for a retest of the June 16 lows to really be able to show or really be able to tell what the market is doing. Because if the market breaks down below this June low, what we're going to see is probably a 3,300 level on the S&P, closer to this here. So we still got a little bit to go. That's kind of like the minimum pain level that you would see. I think I would be inclined, if things get really bad with inflation and inflation can't be controlled and the Federal Reserve amps up its aggressiveness, more of a 3,000, 2,900 level in the S&P, which we don't want to see. But of course, it'll be a humongous buying opportunity if the S&P gets that low. So the underlying factor for all this is, of course, the Federal Reserve. And I wanted to give you guys this article here from Seeking Alpha from Bill Ackman. And of course, Bill Ackman, famous investor, famous stock market investor, runs his own hedge fund. And this is the guy that when the lockdowns, when the Roni started, he went on CNBC and told everybody to sell everything they had, because this was going to be the worst depression we've ever seen in our lifetimes because of the lockdowns and the Roni, okay? And did that come to fruition? No. The Federal Reserve did exactly the opposite of what was expected and became extremely friendly, extremely dovish on the side of investors. And we saw a resurgence of the stock market back to all-time highs and beyond, okay? So when we say Bill Ackman, it's kind of oversimplifying here, but stock market waiting for rate hikes to stop for a buy signal. Yeah, no duh. He's saying, I think once people realize the Fed doesn't have to keep increasing rates and will soon be taking rates down, that's kind of a buy signal for markets. Yeah, duh. Okay, so he's saying, hey, we're going to see a Fed funds rate of 4% probably the next year or so. It's a 2.50. That's another 1.5% increase. That's going to be dependent on the data, guys, right? And the aggressiveness of the Fed is going to be dependent on that data. We talked about CPI, PPI, what energy's doing, what the wages are doing, what rent is doing. We're going to have to watch all that to really see where our big buy points are going to be at. In the meantime, we're just building cash, okay? Now, let me give you this other point here, because there's sort of like another side of that, which is earnings prices and price to earnings, and specifically forward price to earnings ratios, okay? So for those of you that don't know, that don't follow me, this is my favorite indicator for valuing a company. It's called the forward PE. This is the price to earnings of a stock based on the next 12 months expectations by analysts, okay? So we can see here that large cap stocks, this is your Apple, Google, Facebook, the big dogs of tech, are trading at about 16.4 times current forward earnings. And that puts you at a line of pretty moderate pricing, right? Not this extremely good deal, kind of like how it was in 2008 and during the Rona lockdowns right here, okay? So you could think that these companies have a lot lower to go, but Meta trading at 13 times earnings, 13 times earnings in a discount against the S&P, or Google trading at a pretty reasonable valuation. I think Google's trading at 18. You also have Apple at 25. These companies justify these valuations because they're just too perfect, right? These companies have more money than countries. So I don't mind paying a higher valuation for those companies, even though that's not my cup of tea. I think that a valuation of 16 times earnings is justified if the earnings and the estimates don't come down from the companies themselves. And that's what we talked about. Guidance, guys. Guidance. If guidance fails, it means this is no longer the number. It's higher, which means it's more likely going to get sold off in the market. Now, moving on to the mid caps, guys. So mid caps are probably maybe 50 to $100 billion market caps in the stock market. These guys are trading at almost 12 times forward earnings. And if you see here on the chart, in the last 20 years, it kind of almost touches this one here. You're probably looking at 2, maybe 3 times they've been this low in the last 22 years plus. So when it comes to mid-cap stocks, and if you're looking at small caps, which are 11.5 for small caps, and the chart looks very similar, you're looking at 2 times small caps have been as low as they've been in the last 22 years. So when we're talking about minding the earnings of a company and the estimates, if these come down, they've probably already come down significantly. Even if the companies haven't reported a significant shortage of earnings, the stock market has already priced their fall significantly. So you have to consider that a 12 forward PE for a mid-cap name, or an 11.5 forward PE for a small-cap stock is actually quite attractive, depending on the valuation, depending on the stock independently, especially if you're buying these 5x forward PE stocks that have been severely hit by the economic downturn, right? Because of the Federal Reserve induced economic downturn, then you might have some long-term opportunities there to add. So when these go right back up into the 18 and 20s, when the Federal Reserve gets dovish again or gets more friendly to us, then you're going to make a killing in those names, okay? So that's going to be it for my slides today. I want to make sure that you guys understand all this. If you guys have any questions, please let me know. A lot of times I feel like I'm kind of scrambling a lot of things, but I kind of want to give you guys my thoughts and kind of what my feelings are on the market, okay? So don't get too crazy with the buys. Totally okay to pick depending on the stock, depending how beat up it is, and just have a 3 to 5 year outlook. Also, do not expect any instant gratuity. Not gratuity, but don't expect any instant gratification from buying a stock. Don't expect to buy a stock and then expect it to go up like nothing, okay? Expect it to go down. It's probably what's going to happen, but that's okay. You're buying ownership of businesses and increasing your ownership position at cheaper discounts. So when the market gets back up and the Fed becomes our friend again, we make tons of money, okay? Let me know if you guys have any questions. Hit me up on Discord, hit me up on YouTube here on the comment section, or on Instagram and Twitter. Peace out.